80% of your losses can be prevented if you become more aware of your daily mistakes and the little things that hold you back. Just imagine how your account would look like if you'd make those small tweaks and eliminate those bad habits you have. Here's what I've done to reinvent myself as a trader. When I first started trading, I tried to learn everything I could through reading lots of books. I thought that was the key. If I just learned all the strategies and techniques, I'd be able to make profitable trades. But no matter how much I read, it never really clicked for me in live markets. It wasn't until much later that I realized there are two different types of learning: explicit and implicit. Explicit is reading about stuff in textbooks, while implicit is learning through actually doing it over and over. And trading is way more of an implicit learning process than an explicit one. You can study patterns, indicators, and theories all you want, but nothing teaches you like experience in live market. It's all about recognizing opportunities. Trading books and trading videos like this one are most helpful for introductions to new concepts, new knowledge, but what really improves your skill is putting in the time at your screen. Every trade imprints a lesson in your subconscious understanding. Without that hands-on practice, the explicit stuff can only take you so far. Being a consistent trader means knowing your own game. What type of market moves do you excel at reading? Are you better trading breakouts? Do you perform better when the markets are quiet or when there's lots of movement? I had to learn this the hard way. When I first started, I'd force trades anytime the price ticked up or down, regardless of what was really happening. I wasn't paying attention to the previous price action during that day, so during choppy days with no clear patterns, I'd get stopped out with every little wiggle. More often than not, I'd end the day in red without even realizing why. The key is being aware of what types of market conditions you perform well in and which ones are your kryptonite. When the conditions are in your favor, that's when you absolutely got to be on your A game. But if the price action is sketchy and you get that feeling in your gut that you're gonna struggle, you just walk away. It's also crucial that you take some time to analyze what exactly disturbs you. Is it choppy low volume, gaps, fakeouts, ranges, fast price movement? Pinpointing your weakness is half the battle of learning to overcome them. So pay attention to the different market conditions and only trade what you understand. When I first started trading, I thought the way to do it was to just set my stop loss 30 pips below my entry on every trade. That way, it would be simple, right? Well, this strategy didn't work out so well for me. After losing way more trades than I was winning, I soon realized that the markets don't move in a nice, predictable way. During 1 hour, they jump around a lot in a short period, and the next one, they barely move at all. So setting those fixed stop losses didn't account for the natural volatility of the markets. That's when I started using the average true range, or the ATR. This indicator shows you on average how far the market has been moving each day recently. Seeing that helped me understand why just using a fixed number of pips wasn't a good approach, because different markets and time periods have different levels of volatility. So now, when I take a trade, I look at the ATR and use it to help me determine a dynamic stop-loss level rather than a fixed one. I also pay attention to important price points like round numbers, moving averages, VWAP, that could act as support or resistance. That gives me more flexibility to avoid unnecessary losses from normal market fluctuations. Another important topic: when to move your stop loss to break even. On the surface, it seems logical. Once you are no longer at risk of losing, why wouldn't you lock that in? In the past, I made a mistake all the time of adjusting my stops too early, before the market had really proven itself. All I was doing was taking the risk off the table, but I also capped my upside potential too soon. I'd get stopped out of trades that kept running. Now, I only try to move my stop to break even once the market gives me a clear sign that my initial analysis was right. For example, if the price tries to dip back down to my entry point but fails, that tells me my thesis is still valid. Or if it makes a higher high or a lower low, confirming my trend. The key is waiting for strategic levels, not arbitrary ones. Psychologically, it feels good to be risk-free, but statistically, it affects your profits long term. Something that is still a real struggle for me is holding on to winning trades. You hear it a lot. Cut your losses and let the winners ride. It seems so simple, but it's so hard to fight that urge to close out a position early. You know the feeling when you place a trade and things are going great as your position goes in profit immediately, and then the market starts to turn around a bit and you can feel yourself getting nervous. Your hands are then drifting over the close button, just waiting for the smallest reason to exit. And most of the time, you exit. It's because you are scared of giving back those profits you've gained so far. But most of the time, if you took an objective look at the charts, nothing had really changed from a technical perspective. The move was still intact, but you settled for a small profit. And here comes the worst part. The market keeps going like you previously expected. You let your emotions get the best of you, and you've missed out on way more profit potential. It's a common thing in trading, and a really valuable lesson about keeping a level head. This is one of my biggest struggles, even after so many years of trading. When I feel that panic is starting to settle in on a position, I ask myself a simple question. Is there an actual technical reason to exit, or I'm just scared? 9 times out of 10, it's just fear talking. Something I've really been focusing on lately is understanding correlations between different markets I might want to trade. Let me give you an example. Let's say there's a bullish pattern setting up on the pound-dollar pair, and you take a long position. At the same time, pound-yen is also showing signs of strength. Since they both involve the British pound, you might think, great, I'll double up by going long on both. Big mistake, as you didn't properly account for how close the pound pairs tend to move together. So if the pound suddenly pulls back, it will trigger losses on both trades at the same time. Your risk is doubled due to those correlated positions. Be very careful about your exposure. Before entering multiple trades, analyze how the underlyings typically interact. Are they usually in sync like the pound pairs, or do they have a history of divergence at times? Knowing the correlations will help you avoid stacking on too much risk in one direction. Leverage can be a real double-edged sword for traders, especially when you're starting out. I definitely learned that the hard way. When I first got access to leverage, it was super exciting because I thought, great, now I have way more money to place bigger trades and make bigger profits. The result, within a few weeks, I had blown out my entire small account. The problem was that while I was making money on some trades, 1 or 2 losses totally wiped me out because my position sizes were pumped up way too big with a ridiculous leverage of 500 to 1. A small move against me wiped out days of wins. It was a really expensive lesson. Using leverage safely takes experience. I always stress starting very conservatively, no more than 2 or 5 to 1 leverage at most. Keep position sizes small until you can prove you can be consistently profitable. Leverage can come later once good risk habits are formed. As I started to take trading seriously, I realized having a loose plan in my head just wasn't cutting in. I was too willing to bend the rules if I really wanted to take a trade. That's when I started writing out a checklist of everything I look for before entering a position. Now, before every trade, I go through it point by point. Is the chart set up right? Price action looking how I want? Indicators aligned? Supply or demand respected? It forces me to slow down and really analyze objectively. I found it so valuable because it takes the subjective emotions out. There's no room for ambiguous decisions. Either the trade hits all the boxes or it's a no-go. And having it written out makes it very clear if I'm about to break my own rules. The checklist has done wonders for my discipline. Now I avoid so many trades, now that I know deep down they aren't high probability based on my strategy. When it comes to setting profit targets, I see a lot of traders make the mistake of aiming way too high without really thinking it through. I did in the same way. I'd enter a trade and slap on some ridiculous take profit level 100 pips away, thinking the bigger the target, the better. Well, the result, my win rate decreased a lot. You need to have realistic, achievable targets based on actual market structure. Things like nearby supply and demand levels that could reasonably stop a move, or using the ATR to assess the typical daily ranges and taking partial profits within that band. The key is setting targets that balance probability of success with adequate reward. I'd rather have 5 winning trades at 20 pips each than 1 out of 5 going for 100 pips. It's not as sexy aiming for a few pips, but it's way more consistent in the long run. Consistency trumps occasional big wins every single time. Understanding your emotions and psychological biases is so important in trading. We all have fears that can affect our success if left unchecked. We all have inner trading demons. A big one for me was the fear of being wrong. I'd second-guess winning trades because I was worried I might miss something, or I'd hold on to losers trying to be right. Another struggle is the fear of missing out, feeling like I had to jump in a move whether my strategy said to or not. I also used to bail early on wins due to worries they'd reverse. Managing ego is another one. Recognizing your patterns early is key. Find out what are your own biases and what can you do to diminish their influence on your trading. And sometimes, taking a break is the best move. At the beginning of last year, no matter what trade I'd put on, I seemed to pick the wrong side every single time. And it was getting frustrating watching my profits decreasing. And my mind wasn't as sharp as usual. I started questioning every decision and second-guessing myself. I needed to step aside. As much as it pained me to leave the action, I knew staying in this mental state would only lead to more bad decisions and losses. I had to clear my head. So I decided to take a break. No charts, no books, no trading apps, no videos for 2 weeks. And it wasn't easy at first. I really missed the excitement and the rush of placing a trade, but it was the time to refocus. After that period, I was ready to get back in the game. And with a cool head, I came up with some minor adjustments to my strategies. Taking breaks from trading is absolutely necessary when things don't go as planned. The markets will always be there. It's more important we take care of our mental well-being.